What the heck is going on with interest rates now? Will this decline continue? If you're a realtor or friends with a realtor, you've likely seen this graphic shared on social media in the last couple of days. It's from an account called Keeping Current Matters that posts things about real estate for real estate agents. It shows that interest rates have gone down about 1 percentage point since their high in May of this year. If you try to dig in a little bit further, though, they don't give a ton of information on what that actually means and where things are going. This is the article from their website. It goes into the trends a little bit, and it talks about the relationship between rates and demand. I'll summarize that just by saying, as money gets cheaper, more people can afford to buy things, and that creates more demand. So lower interest rates, more demand, generally speaking. So it's important to know why this stuff happens. Why do interest rates rise and fall? They are pegged to what's called the 10-year treasury, and that moves off of something called the Fed funds rate. Now, this isn't the Feds, like the people who like kick in doors and bust drug dealers. This is the Federal Reserve, the people that set monetary policy. They quite literally print money and determine how much, what rate they're going to lend to banks at. Then banks turn around and lend that money to us as consumers in the form of auto loans and home loans. And they also lend to corporations so they can do things like build factories and expand. So the Federal Reserve is kind of at the head of everything economically and monetary policy speaking in the US government. And the Federal Reserve looks for different signs to make decisions about whether or not they will change interest rates. So when you just quickly Google the US unemployment rate, you'll see this graph, and it generally looks good or better than where we were during COVID. And while that is true, we are not headed in the right direction. So if we dig a little bit deeper and we go into an article here from NerdWallet, you can see that the unemployment rate in August went up to 4.3%. The prior month, it was at 4.1%. That's now, I believe, 3 months in a row with unemployment going up. And that's a strong indicator that we could be heading into a recession. Now, recession doesn't automatically mean that we're going to, be wiped out, that food on the shelves are going to be wiped out. I'm not trying to freak out in that type of way. I just want you to know what's going on and what drives this stuff. Now, this is generally bad news for the economy. It means that the economy is weaker, that things are slowing down, which also means in general that inflation is probably weaker. And those are actually good signs in a way for the Federal Reserve, because that means that the higher interest rates are working. They're starting to throw the brakes on the economy, because inflation is simply the economy growing too quickly. So when they see things like unemployment increasing and a couple other trends, they start to say, well, gee, maybe it's time to make money cheaper again. That way people will buy more things and banks will be able to lend more to corporations. So the Federal Reserve meets a couple times per year and has these big meetings where they decide, are they going to do anything with monetary policy? There's a big meeting coming up in September. That's the next time they're set to meet. And it is being strongly hypothesized that rates will go down at that meeting. Don't worry too much about what these percentages mean. They're related to the Fed funds rate. This is not mortgage rates. Just look at the probabilities here. It's important to note that this adds up to 100%. Wall Street, who they're betting tons and tons of money on this stuff, are putting strong odds at there being a decrease in the federal funds rate. Now, it's possible that mortgage rates may decrease more in September when that rate change comes, but it's possible that they will not. The market is very efficient, as they say, and the market has already priced in the rate cut that is expected in September. So if the Fed decides to drop the federal funds rate by 0.5 percentage point, that does not mean that mortgage rates will drop by 0.5%. I would be shocked if they dropped that much. It is a good sign in a sense, though, because it means that we will have started the process of cutting rates to re-engage economic activity. Now, like I said at the beginning, when rates go lower, money goes cheaper. Your monthly payment on a house gets cheaper. Hooray. The only problem, if you're a buyer, that means there's more demand and you may be competing against more people. It's very simple just to Google some of these terms and keep a quick eye. I encourage you to look at sites like Yahoo Finance. That's one of my favorites. It tends to be pretty unbiased and just report the facts. Know that each different news outlet will have its own spin on things. Hope this helps. If it was, drop me a DM or let me know